Most people believe investment underperformance is a knowledge problem. They assume they chose the wrong assets, missed information, or entered at the wrong time. This framing is comforting. It suggests that with better insight, better tools, or better analysis, results would improve. In practice, that is rarely what determines outcomes. Most investors underperform not because they're wrong, but because they're involved. The problem isn't a lack of intelligence, it's the presence of choice. Markets are volatile by design. Price movement is not evidence of failure, it's the day-to-day of participation. Returns exist because uncertainty exists. If outcomes were smooth and predictable, they would already be priced in. Market volatility is not an obstacle to returns, it's the mechanism that produces them. The difficulty is not enduring volatility, the difficulty is in knowing how to respond to it. Underperformance does not usually arrive as a dramatic mistake, it arrives through a sequence of reasonable actions. First, markets fall. Losses are framed as temporary, declines are monitored, and attention increases. At this stage, discomfort is present but contained. Then, uncertainty extends. The decline lasts longer than expected. Recovery does not arrive on schedule. Explanations multiply. This is the point where the system requests intervention. Action feels required. The first intercession is rarely extreme. Exposure is reduced slightly. Risk is described as being managed. Decisions are framed as caution. It feels like a responsible response. And importantly, it also feels reversible. At this stage, most investors will still feel in control. Then the market turns. Not decisively and not with clarity, but prices begin to recover, while confidence does not. Participation has already been reduced. Re-entry now requires a second decision. Waiting feels prudent, the system encourages patience. But then recovery accelerates, gains cluster unevenly. The strongest periods arrive suddenly and without warning. So by the time confidence returns, prices have already moved. Re-entry feels expensive. The original position is not restored, the gap is now locked in. This is the critical moment. The loss is no longer temporary. The system is now underexposed during recovery. Compounding resumes without your full participation. Nothing catastrophic occurred. No single decision ever appeared reckless. But underperformance is now permanent. This sequence is not rare. In fact, it's typical. It does not require panic. It only requires discretion at the wrong time. Trying to be careful ends up costly. Underperformance is often blamed on taking too much risk. But in practice, it's often caused by attempting to reduce risk dynamically. Risk is highest when prices are lowest, and reducing exposure at that moment does not remove it. It relocates it. From instability to absence, from discomfort to indecisiveness. Markets don't compensate investors for caution. They compensate investors for bearing uncertainty. Attempts to minimize short-term discomfort often lead to long-term damage. The cost is difficult to perceive because it's intangible. It appears only in hindsight as a gap that can't be closed. There's a piece of finance folklore that illustrates this. It's often said that a small number of days each decade account for a disproportionate share of long-term returns. Whether the exact count is 5 or 10 is beside the point. The idea persists because the underlying pattern is real. Returns tend to cluster around periods of maximum uncertainty. Investors who reduce exposure during those periods are rarely around when returns resume. Not because they lacked conviction, because they were absent when it mattered. Doing nothing avoids this sequence entirely. There is no reduction in exposure, no decision to reverse, no re-entry to miss time. The system remains present during recovery by default. This isn't foresight, just the absence of action. Most investors cannot do nothing, not because they lack discipline. They're engaged and conscientious, actively looking to better their circumstances, but their systems invite involvement. Balances are visible, prices update constantly, choices are always available. Each update is an enticement, and even the most restrained can only hold out so long under repeated exposure. Systems that allow decisions during stress will eventually lead to decisions made during stress. This is not a behavioural flaw, it's a design outcome. A system that outperforms must assume this. It must remove the ability to act when action is most harmful. This is why doing nothing is not passive. It's constraint, by design. Ironically, doing nothing is only possible when it's enforced. When exposure is established in advance. When changes require friction. When intervention is rare and structural. Without this, inactivity is only an intention, and even the best intentions falter under pressure. Most people underperform the market because their systems allow it, because they're permitted to respond to pressure. Doing nothing outperforms because it removes that permission. Markets reward survival. They don't reward vigilance, responsiveness, or effort. They reward remaining exposed through conditions that would otherwise invite change. The most reliable way to outperform most investors is not to be smarter, not less informed, but less involved. This is why doing nothing works, not because it predicts the future, but because it refuses to react to the present. It's the recognition that while you can't control the market, you can control the one thing that usually gets in your way: yourself. This is boring money, and boring is how wealth is built.